You finished the monthly performance deck and the charts are aligned. The ROAS is green. You've even checked that one mysterious tab. Finance presents first. Revenue this month was $950,000. Your slide says $1.2 million. The thing is, both numbers might be correct. They just might not mean the same thing. The first mistake is assuming that revenue is one universally agreed number. It's a metric with 4 different names. Finance is trying to establish what revenue the business earned within a particular accounting period. Marketing is trying to establish which campaigns, channels, or customer interaction should receive credit for a commercial outcome. The questions aren't the exact same, but they are related. Therefore, before you compare revenue, you need to ask revenue according to whom, recorded when, and calculated how. Imagine a customer places a $1,000 order. Finance may later reduce that amount because part of the order was refunded. They may recognize the revenue when the product or service is delivered rather than when somebody clicks buy. Side note, if your data foundation isn't designed carefully, it could mistakenly report $3,000 instead of $1,000 for the customer order, but that's a topic for another video. Point being, every platform and team is the hero of its own dashboard. So attribute revenue is an allocation of credit attached to underlying transactions. Recognized revenue is the amount the business has actually earned under its accounting rules. The second major difference is time. A single sale can have an ad click date, an order date, a payment date, an invoice date, a shipment date, a delivery date, and possibly a refund date. Finance may place the revenue in the period when the company has actually delivered what it's promised. Your e-commerce system may report it on the order date. Your payment processor may report it when the payment clears. An advertising platform may associate it with an earlier ad interaction. Even within Google Analytics, attribution reports can be viewed using event time or ad interaction time. So when marketing compares January with finance, one team may be grouping transactions by purchase date, while the other is grouping them by fulfillment or recognition date. The third difference is what each system includes in the number. Does revenue include tax? Does it include shipping? Is it before or after discounts? Have refunds and cancellations been removed? Are failed or fraudulent payments still present? Are subscription sales reported as the full contract value or only the amount recognized this month? And which exchange rate converted a transaction into the company's reporting currency? These are not small technical details, they're the definition of the metric. For example, Google Analytics distinguishes item revenue from other values and defines item revenue as revenue from the items themselves, excluding tax and shipping. That may differ from the value passed into an advertising platform, the gross order value in an e-commerce system, and the net revenue recognized by finance. So what should you actually do when the marketing and finance report different revenue numbers? Start with one closed reporting month and follow 4 steps. First, agree on the definition of revenue. Decide which transactions count, which date is used, and how refunds, cancellations, tax, shipping, discounts, and currency are treated. Without that definition, you're not comparing numbers, but you're comparing interpretations. Second, reconcile the data at a transaction level. Use an order ID, invoice ID, or payment ID to match the revenue in finance with the conversions reported by marketing. Third, place every difference into a category. A timing difference, a refund or cancellation, a difference in tax, shipping or discounts, a currency conversion difference, an unmatched transaction, or an attribution difference where multiple platforms claim credit for the same sale. So the goal isn't always to make the two totals identical, it's to make the difference more explainable. You want to be able to say, finance reported $950,000, marketing reported $1.2 million. Finally, make the process repeatable. Create one shared transaction dataset with agreed revenue rules, reliable transaction IDs, and separate fields for marketing attribution. Then add checks that flag missing orders, duplicates, unmatched conversions, and refunds that have not flowed through. To summarize, take 1 month of data, match the transactions, and explain the gap. This exercise will tell you whether you have a reporting problem, a definition problem, or a deeper data foundation problem. We've put together a free practical reconciliation checklist covering the key areas discussed in this video, which you can use with your marketing and finance teams. You'll find the link in the description.